Have you ever wondered why even experienced traders fall prey to the same devastating mistakes, repeatedly wiping out their accounts? It's a universal struggle, often leading to significant financial loss and frustration, despite all the knowledge and effort. Consider Alex Chen on September 14th, 2025 at 9:32 a.m. He opened his trading terminal with his entire life savings of $47,000. He executed his trade, confident in his setup and an $800 stop loss, believing everything was perfectly managed. Yet, just 6 hours later, his balance plummeted to $34,000. A staggering $13,000 vanished, not from one error, but 4 recurring blunders. These aren't unique failures. They are the very same pitfalls that entrap 90% of all traders. Let's uncover the reality of what truly happened. What's truly astonishing is the consistency of these errors. Across 10,000 analyzed trading accounts, despite varied markets and strategies, the same 4 mistakes emerge. For instance, 78% of traders panic and override their stop losses, while 85% engage in revenge trading after a loss. Furthermore, 92% cling to losing positions for too long, and 71% perceive non-existent patterns in market noise. This isn't just Alex's battle, it's a collective human challenge. So, why do we fall into these traps? Our brains, honed for survival over 200,000 years, react instantly to perceived threats. Imagine an ancestor hearing rustling in the bushes. Their brain screams, "Danger!" in 0.2 seconds, triggering an immediate flight response that saved their life. Fast forward to today, a sudden red candle appears on your screen. That same ancient brain instantly shouts, "Danger!" causing your hand to hit the close button without thought. This primal survival mechanism, designed for lions, now misinterprets a dropping stock price as an existential threat, often destroying your trading account. Your brain cannot distinguish between a jungle predator and a market downturn. Both elicit the same instant, often detrimental reaction. This is the core of your trading problem. We can categorize these instinctive responses into 4 distinct traps, each triggering an immediate, unthinking reaction. Instead of relying on sheer willpower or self-discipline, a specific counter-system is needed, a robust architectural approach to trading. Let's explore each of these 4 distinct traps and the corresponding systems designed to overcome them. The first is the pre-trade protocol. You must meticulously plan your strategy when calm and commit to it before entering any position. Next, the break protocol mandates stepping away from your screen for a full 15 minutes after experiencing any loss, forcing a pause. Then there's the red line system, which means setting your absolute maximum loss before a trade with an automatic, unchangeable closure if that limit is hit. Finally, the validation checklist requires every potential trade pattern to pass 7 specific checkpoints. If even one fails, the trade is off. We'll delve into each trap's psychology, the precise system to combat it, and witness how Alex completely rebuilt his trading account using these very tools. On September 14th at 9:47 a.m., Alex had an active trade. The price began to fall sharply, heading directly towards his predetermined stop loss of $4,950, risking $800. Watch closely as events unfold in real time. At 9:47 and 23 seconds, the price plummeted. Just 0.2 seconds later, his hand instinctively moved. By 9:47 and 23.6 seconds, Alex's position was closed. He acted half a second before his automated stop loss would have triggered, turning an $800 potential loss into a $2,400 deficit. A staggering 78% of traders exhibit this behavior, not due to a lack of resolve, but because a mere 0.2 seconds is enough to bypass all rational thought. Imagine driving. A deer jumps out and in 0.15 seconds, your foot slams the brake. You didn't think. Your survival system simply reacted. It's the same in trading. A rapidly dropping red candle appears, and in 0.2 seconds, your hand hits the close button. You didn't think close, you simply closed. While this instant reaction saves you in a car, in trading, it catastrophically derails your carefully laid plans. Your brain's primal response always comes first. By the time you consciously recall your stop loss, it's too late. The button is already clicked. You can't prevent the panic reflex, but you can prevent yourself from acting on it. To combat this, step 3 is a physical reminder. A sticky note on your monitor. It declares your plan locked, forbidding any manual overrides. Step 4 introduces an execution block. This disables or hides the close button, preventing you from overriding your stop loss during moments of panic. The effectiveness lies in panic's short duration, typically 3 to 5 seconds. By the time your hand finds the disabled button, rational thought often returns. Consider Alex's 23rd trade. As prices plunged, his hand instinctively moved to close, but the button was grayed out. After 4 seconds of intense panic, the price rebounded. This prevented an $800 panic-induced loss, securing a $1,200 profit instead. Later, at 10:15 a.m., Alex closed another trade with a $2,400 loss. Furious, his mind screamed, "Win it back!" This triggered a rapid spiral. He immediately opened a new trade, doubling his size, analyzing nothing, driven only by a desperate need to recover. The result was another $3,200 loss, intensifying his anger. He then made another trade, tripling his size, losing $4,100 more. This revenge trading spiral often continues until the account is depleted. A staggering 85% of traders engage in it, yet their win rate is a mere 23%. This dramatically lower win rate compared to a normal 45% exists because you're trading for emotional relief, not strategic advantage. Imagine a child dropping ice cream, crying, "I want another one right now." The parent advises patience, but the child insists, "No, right now." You cannot reason with that child. Their emotions are too high and logic is offline. The same applies to a trader after a loss. Your brain screams, "Win it back immediately." Your plan says to wait and analyze. But when emotions peak, reasoning with yourself is impossible. Maxed out emotions halve your IQ, clear thought vanishes, replaced by an urgent need to fix things. You can't stop the emotional spike, but you can stop trading during it. This is where the break protocol comes in. Step 1. Any loss triggers it, locking your platform for 15 minutes with no override. Step 2 of the break protocol involves engaging in physical activity, such as stepping outside, doing push-ups, or splashing cold water on your face. A critical rule during this period is to strictly avoid any trading applications on your phone. Next, step 3 focuses on specific activities designed to reset your brain, like a brief 5-minute walk around the block, practicing deep breathing, or even calling a friend. The overarching goal is for physical engagement to neutralize elevated emotions. Finally, step 4 outlines the rational re-entry phase. After the 15-minute timer expires and your trading platform becomes accessible again, you must answer crucial self-assessment questions before considering any new trades. You need to ask yourself, why did that loss occur? What is my current emotional state? And do I genuinely perceive a clear trading opportunity? If your emotional score is above 5, the platform remains locked. This system's effectiveness stems from the fact that intense emotions peak immediately after a loss, while your rational, cognitive functions typically return within 10 to 15 minutes. The break protocol deliberately compels you to wait for this mental clarity. Take the real-life example of Alex on October 8th. He suffered a $1,200 loss and instantly felt the urge to jump back into trading. However, the break protocol activated, locking him out of his platform. He then walked around the building for a while. When he returned after the 15 minutes, his emotional state was calm. After reviewing the charts and finding no favorable setups, he wisely decided to close his platform for the day. This disciplined action saved him from what would likely have been a revenge trade, potentially incurring another $2,000 loss. It truly demonstrates the protocol's protective power. In a different scenario, at 11:30 a.m., Alex immediately entered a new trade, which quickly resulted in a $300 loss. He rationalized, "It's just a small pullback, it will reverse," but it failed to do so. The loss escalated to $500, then $1,000, as he desperately clung to the thought, "It has to bounce here." The situation worsened to $2,000, then $4,000, with him adamantly believing, "I'm right on this, I know I am." As the loss spiraled to $5,800, he pleaded, "Please just come back," before finally closing the position, utterly unable to bear the pain any longer. His initial stop loss was set at a mere $500. Why did he let a $500 loss balloon to $5,800? The answer is hope. An astounding 92% of traders fall into this pattern, allowing an average $300 loss to grow into $2,100. It's comparable to using a phone with a badly cracked screen, hoping it might somehow work better, or restarting it when a friend suggests replacement only for you to object. "But I already spent $800 on this one." Similarly, when your trade is clearly losing, you hold on, hoping for a reversal, and the loss only worsens. Even when the system prompts, "Just close it," you respond, "But I already lost $2,000. Here lies the trap. Losing $500 is painful, but admitting you were wrong often hurts even more. So, your brain chooses not to close, creating the illusion that if you don't exit, you're not yet incorrect. Fortunately, you possess the ability to prevent yourself from being swayed by mere hope. This is where the red line system comes into play, a structured approach with 5 distinct steps. The first step requires you to define your red line before initiating any trade, establishing your maximum acceptable loss. This should typically be 1 to 2% of your account per trade. So, for a $50,000 account, a $500 to $1,000 limit should be explicitly noted. Next, in step 2, you must calculate your position size. For instance, if your entry is $50 and your stop is $49.50, risking 50 cents per share with a $1,000 maximum risk means you can buy up to 2,000 shares. Step 3 emphasizes automatic execution, the most effective method. This involves placing a hard stop-loss order simultaneously with your entry, making it impossible to override, adjust, or remove later. Step 4 is the acceptance phase. Before entering, verbally acknowledge or write down, "If this trade hits my stop, I will lose $800. I accept this risk, and I will not move my stop." Confirm this commitment in your trading journal. Finally, step 5 outlines the post-stop protocol. Once your stop is triggered and the position automatically closes, you must immediately disengage. This means taking a 15-minute break and absolutely no revenge trading or attempts to re-enter. An advanced technique is the trailing red line. As your trade moves into profit, your red line moves up, never down. If your entry was $50 with a stop at $49.50 and the price hits $51, you move your stop to $50.25, securing some profit. Should the price further increase to $52, you'd then adjust your stop to $51.50, locking in even more gains. The fundamental rule is that your red line only progresses towards profit, never towards a greater loss. This system's effectiveness lies in its ability to eliminate emotional decision-making. When the stop is hit, the trade simply closes, removing any lingering questions like, should I hold a bit longer? Or maybe it'll turn around? The stop being hit means it's done. Consider Alex on November 3rd, entering at $51 with a red line stop at $50.25, risking $750. As the price dipped to $50.30, then $50.28, and finally $50.26, Alex might have hoped for a reversal. However, his stop at $50.25 automatically triggered, closing the trade for a $750 loss. The price subsequently plummeted to $49.20, demonstrating how the red line saved him from an even larger $1,800 deficit. Later, at 2:30 p.m., Alex, now down $18,000, desperately sought a winning trade to salvage his account. He stared at charts, convinced he saw a perfect head and shoulders pattern, confirmed by volume, MACD divergence, and Fibonacci levels. Believing all signals aligned for a sure win, he went all in with $29,000. But by 2:52 p.m., he was stopped out, his account balance reduced to zero. The supposed perfect pattern was merely random noise, a false breakout, a liquidity trap. This scenario highlights a common pitfall. 71% of traders overtrade based on false patterns. Most patterns have a 50-50 outcome, appearing perfect only because your desperate mind needs them to be so. It's like looking at clouds and seeing faces, dogs, or dragons, when in reality, they are just random formations. Our brains are wired to detect patterns everywhere, a trait known as pareidolia, which evolved for survival. Upon closer inspection, only 30% of patterns pass all 7 validation checks, but these select few boast a significantly elevated win rate. Alex, on December 12th, believed he'd found a perfect flag pattern, igniting his enthusiasm as he initiated his structured checklist. The first checkpoint immediately failed, as the pattern was only visible on a 5-minute chart, and the second lacked essential volume confirmation. With a mere 2 out of 7 checks completed, he decided to bypass the trade. The price remained stagnant, confirming the checklist saved him from futile effort. This experience underscores the necessity of integrating all 4 systems into a comprehensive psychological operating system, much like seasoned professionals do. The first is the pre-trade protocol. Meticulously plan when calm, lock in parameters before entry, and strictly forbid panic-driven overrides. Next, the break protocol dictates that any loss triggers a mandatory 15-minute lockout, forcing a physical and mental reset. Third, the red line system demands a maximum loss decision before any trade, with an automatic stop loss in place to prevent clinging to false hope. Finally, the validation checklist requires 6 out of 7 checkpoints to be met, prioritizing evidence over impulsive excitement, thus creating decision-free trading. These 4 interconnected systems prevent your brain from sabotaging your efforts, but you must actively build them into your routine. Week 1 focuses on the pre-trade protocol. Meticulously document your entry, stop, target, size, and risk, then physically place your stop loss before opening the position. Week 2 implements the break protocol. Install an auto-lock script for 15 minutes after any loss, forcing you away from your desk for a physical activity like walking or push-ups. Week 3 introduces the red line system. Calculate your 1 to 2% max risk per trade. Use a position size calculator and acknowledge your risk by signing a pre-trade acceptance. Week 4 establishes the validation checklist. Create and print a template with 7 checkpoints, ensuring no trade is placed without achieving a score of 6 or higher. By week 4, your system is functional, ready for the ultimate test in the live market with real money. Let's revisit Alex's journey 6 months post-disaster. By the 4th week, your personalized system is up and running. Not yet perfect, but entirely functional. Then comes the true examination, engaging the live market with real funds. Let's observe Alex's return on March 20th, 2026, half a year after his devastating setback. He diligently rebuilt his account, growing it from $34,000 to $41,000 through consistent, albeit unspectacular progress. During today's trading session, watch the stark difference. At 9:32 a.m., he opened a trade, having meticulously documented his pre-trade protocol and secured his stop loss. As the price declined towards his stop, the old Alex would have panicked, overridden his plan, and exited prematurely. But the new Alex stood firm, his stop locked and unchangeable. He calmly waited as the stop triggered, accepting an $800 loss precisely as planned, a controlled outcome rather than a chaotic one. At 10:15 a.m., the break protocol engaged, locking his platform for 15 minutes. Where the old Alex would have sought revenge, doubling down to a $3,200 loss, the new Alex stepped away. He took a deep breath outside, returning after the mandated break with a calm demeanor. Finding no valid setups, he simply closed his platform, avoiding another potential $2,000 revenge loss. Later, at 11:30 a.m., he entered a small losing position. The old Alex would have clung to hope, watching the loss swell to $5,800. Instead, the new Alex had his red line set at $500. The system automatically closed the trade, containing the loss to just $500, averting a much larger financial hit. At 2:30 p.m., he spotted what appeared to be a perfect pattern. The old Alex would have gone all in with $29,000, only to be wiped out by a false breakout. The new Alex, however, diligently ran his validation checklist, scoring only 3 out of 7 due to failing time frame and volume criteria. He wisely skipped the trade. The price went nowhere, confirming it would have been another costly trap. By day's end, he had one controlled loss of $800 and successfully navigated 3 significant temptations. His account moved from $41,000 to $40,200, a small, contained loss. Over 6 months, his win rate remained 43%, but his average loss plummeted by 68%. This transformation proves that robust systems prevent disaster. No longer does a single bad day erase the gains of many good ones. It's about protection, not unattainable perfection. Now it's your turn. Build these 4 systems over 4 weeks to create a psychological operating system that your brain cannot hijack. If this resonated, hit like and subscribe for more insights into mastering your trading psychology.